Today we're looking at a pretty high-energy, contrarian take on TerraWulf, ticker WULF.
Yeah, the core idea is that this recent 10% dip is a buying opportunity because the company's really pivoting from a Bitcoin miner to more of an AI infrastructure play.
It's a really timely thesis, especially since that whole bet, it hinges on the market seeing WULF differently than its peers.
Exactly.
And it's a strong foundation. The investment idea is compelling for sure, but I think there are three areas where we can really sharpen the analysis report to maximize its impact.
Right. Elevate it from just a strong opinion to a really definitive analytical case.
Yeah, exactly. Let's start with the overall tone.
Okay.
I think the first hurdle here, the thing that might stop it from landing with, a really sophisticated investor, is that sensationalized, almost promotional tone.
The conviction is definitely there, which is great. You feel it, and the analyst has found a legitimate catalyst, that AI pivot is real. But the way it's presented, it's just so aggressive. It almost undermines the credibility.
Absolutely. I mean, you see phrases like massive gift, fire sale, and that opening, wolf crash alert.
With the siren emoji?
Right. It's all designed to get an emotional reaction. It's meant to stir up fear, then excitement. And that feels more like hype than a sober, logical investment case.
And guess what they're going for? They want to create urgency, grab your attention right away. But for the kind of investor this is aimed at, that sort of hyper-bullish language, it can set off alarm bells.
It does.
They immediately start thinking, okay, if the facts are so strong, why do you need the all caps and the emojis? It almost signals that maybe the data isn't strong enough to stand on its own.
That's the key right there. The tone becomes noise that just gets in the way of the signal. So the weakness is that the language really risks hurting the perceived analytical rigor.
So the suggestion then has to be to just modulate that intensity. Let the facts do the heavy lifting. The zero carbon power, the capacity they have, that whole logical transition to a higher valuation. That's the powerful stuff. The conviction should come from the analysis, not the shouting.
So practically speaking, you strip out the personal part, the why I'm buying, and all the sensationalism from that opening.
Yeah, instead of focusing on a personal trade, it should pivot immediately to a substantive, analytical question, something that sets the stage for the facts.
Like reframing the opener completely.
Completely. What about something like assessing the WULF pullback, why the accelerating HPC thesis warrants a contrarian position?
I like that. It immediately shifts the focus from, one person's trade to the analytical justification for that trade. It sets a professional tone from the very first word.
And that change alone takes this from feeling like a market alert for day traders to a real thesis-driven analysis for, serious capital.
Yeah, and you have to carry that discipline all the way to the end. The conclusion has this very conversational, charged language. I'll see you on the moon. Rocket. Peace.
Right. That might work on, say, Twitter or Reddit, but for a document that's trying to be a serious piece of investment analysis, it weakens the whole final summary.
It creates this weird disconnect. You read this logical argument about an HPC pivot, and then you're hit with that. The whole thing just kind of risks falling apart in your mind. So what's a better alternative for that conclusion? Something more concrete.
Well, it should just replace that emotional sign-off with a strong, grounded summary of the quantitative data. The report mentions the positive adjusted EBITDA, the 87% year-over-year revenue growth. Those are the facts that matter.
So, instead of a cartoon rocket, you close with actual demonstrated execution.
Exactly. Something like, WULF's execution of its zero-carbon strategy, evidenced by 87% year-over-year revenue growth and sustained positive adjusted EBITDA, suggests this pullback offers a structurally supported entry point as the higher multiple HPC transition gains speed. It leaves the reader with a powerful, measurable thought.
Anchored in reality. Okay, that's a great point. Let's move on to the second major area for improvement.
Okay.
The entire framework here is this contrarian buy the fear idea. But for that to work, for it to be more than just a slogan, the analysis needs to actually acknowledge and then dismantle the reasons for that fear.
This is the big gap for me. It correctly calls the stock drop a gap and trap, and then just blames it on profit-taking or healthy consolidation.
Right. And then it says nothing fundamentally changed. But it's not enough.
It's a dismissal. And a really powerful contrarian argument requires a direct fight with the reasons for the sell-off. You can't tell a sophisticated investor to buy the fear if you don't even define what the fear is.
That is the core weakness. By just brushing it off as consolidation, it leaves these huge unanswered questions. A smart investor's immediately going to ask, okay, if nothing changed, why did the market just dump 10% of the stock? What risk is it pricing in?
Yeah, they know a 10% drop isn't just random noise. It's usually driven by some new interpretation of risk. And that interpretation has to be addressed head-on.
So to really make this stronger, the analysis needs to proactively identify and then rebut the most likely bear arguments, especially around this whole HPC pivot.
So what would those be? I can think of two right off the top of my head.
Go for it.
First, there's the capital risk, right? Shifting to data centers costs a ton of money. So the bear case is that WULF is going to have to dilute shareholders or take on huge debt while they wait for these HPC contracts to come online.
That makes sense. And the second?
The second is just that perception risk, that they're still tied to Bitcoin's volatility no matter what they say. So this drop could be seen as proof that they haven't really decoupled from the crypto market's whims.
Okay, those are both very real concerns. So the suggestion is, right after discussing the crash, the report needs to bring these up and then just knock them down with the company's actual strengths.
Precisely. Instead of just jumping to the bull case, maybe add a little section, addressing the skeptics, or something like that. And then in it, you ask the questions. Is this sell-off about execution risk in the HPC build-out? Or maybe a concern about financing the expansion at Lake Mariner? It shows you've thought about the other side of the trade.
And then you use WULF's actual advantages to neutralize those concerns. You turn their risks into strengths.
Exactly. If the fear is about capital, you point directly to their balance sheet. That, 140 million plus in cash they're holding? You argue that basically negates the capital risk you see in other, less established data center companies.
And for the Bitcoin volatility argument?
You lean into the zero-carbon infrastructure. That is their massive competitive advantage in the data center world, where power is everything.
Right.
By highlighting that, you can argue WULF isn't just another cyclical Bitcoin miner. Their infrastructure puts them in a whole different category, really regardless of what Bitcoin's price is doing short-term.
So that sequence, acknowledge the risk, rebuke with data, that's what builds the credibility you need for a buy the fear call.
It transforms the argument from nothing changed to here's what the market thinks changed, and here's the data proving why that perception is wrong. That's a huge structural improvement.
It really is. Okay, fantastic framework. Let's pivot to the final and maybe the most important area, building that valuation bridge between the AI pivot and the $26 price target.
Yeah, this is the whole payoff. The AI secret weapon. The argument that WULF should be valued like a high-growth tech company, not a cyclical Bitcoin miner.
The report does a good job highlighting the operational pieces, the power, the zero-carbon angle, Lake Mariner, all of it. But the jump from that to a $26 price target, which is a 50 to 80% upside, it feels a bit like a leap of faith.
It is, and the weakness is that it's relying on just citing an analyst's target as proof.
Right.
An expert reader sees that and thinks, okay, but show me the math. Citing a target gives you a direction, but without the underlying model, the argument just feels fragile.
So we need to actually quantify how this HPC pivot leads to a higher valuation multiple. A sophisticated investor wants to see the work.
They have to see the mechanism. So the suggestion here is to introduce specific projections, maybe based on the revenue mix, that show how the valuation shifts. And you can use Lake Mariner as the concrete proof of concept.
So instead of just saying, analysts are starting to value them like a tech company, you actually show the numbers that would make that happen.
Exactly. You could start by defining their current valuation. Let's use EV to EBITDA. For Bitcoin miners, that multiple is maybe 4x to 6x? You benchmark them there.
Okay.
Then you project how that multiple expands once, say, 20% of their revenue comes from these higher multiple HPC contracts.
And that's where the comparison to the pure play AI infrastructure companies comes in, because they trade at much higher multiples, right?
Much higher. You're looking at specialized data center REITs, other AI plays. They can trade well into the teens, maybe 12x to 18x EV/EBITDA. That difference is the engine of this whole thesis.
So can you give me a concrete example? How would the analysis report actually frame that comparison?
Sure, it could have a small, direct section. Maybe call it Modeling the Multiple Shift. And it could say something like this. Current WULF valuation at 100% mining revenue. An estimated 5x EBITDA multiple, in line with peers. Now, projected WULF valuation with 20% HPC revenue.
Okay, I'm with you.
If those HPC contracts are valued at a standard 15x multiple, a simple weighted average calculation expands WULF's blended multiple to around 7x or 8x, and that expansion provides the analytical bridge toward that 26 target.
That 7x to 8x blend is the key, because it immediately breaks WULF out of that commodity miner peer group and puts it into a different category,
A specialized green energy infrastructure category.
which is the pivot the whole analysis is arguing for. It validates the price target without just borrowing it from someone else.
It turns an assertion into a quantified model. And for this audience, that is essential. It gives them the specific justification they need to feel comfortable making a contrarian bet.
And it moves the whole argument from just speculation into actual financial modeling. That rigor is what's going to win over a skeptical investor.
Precisely. And the fact that the company is already executing well, that positive EBITDA, the 87% growth, that's the foundation that makes the model believable. It's based on reality, not just hope.
That concludes our look at this analysis report today. So, we focused on 3 core areas to really strengthen this high-conviction idea for a more skeptical expert audience.
Yeah, first was adjusting the tone. We suggested moderating that hyperbolic language and letting the facts, not the hype, create the urgency. So, replacing "see you on the moon" with a quantitative summary.
Second, we talked about bolstering that buy the fear thesis by actually tackling the bear case head on. The analysis has to confront the real reasons for the sell-off and use WULF's strengths, like its cash pile, to neutralize those fears.
And third, we focused on building an explicit, metric-driven bridge to justify that $26 price target. We really urged the analysts to quantify the multiple expansion with the blended model instead of just citing other analysts.
Right.